Today I'm chatting with Simon Gillespie, who's a Senior Finance Advisor and an investment savvy finance specialist. And we're going to talk about the question, is interest rate really that important? And I must admit, Simon, I often get that question from clients where they just say, what's the best rate you can get me? And it's probably not the best question they should ask, is it?
Well, it depends on your intention. So let's say for those people who want to go and buy a home and that's all they want to do, well, cost, rate, very important. But let's say for our clients who typically aren't just about the home, but it's about that long-term wealth creation, build a portfolio. Rate is a part of the conversation, but it's not the conversation.
Yeah, it's a good way to put it. I always think that building a portfolio of property, it's a game of finance more than it is a game of bricks and mortar. And so I think you really need to understand the principles of finance to really understand how to build a portfolio. So what I thought we'd do today is chat about some of the things that you come across when you're building portfolios for clients and some of the things they should focus on and perhaps some of the things that they should probably not focus on so much if they want to achieve their end game. So you've got a bit of a framework or a structure when you're talking to a client that you take them through. What is that?
Yep, so rate is, as I said, part of the conversation, but typically it starts at the top of structure. What do I need? How am I going to get from where I am to where I want to be? So what's the type of loan structure I need? From there, we filter down into, well, who's the lender that's going to give me the preferred structure to complete the portfolio? And then what falls in behind that is, how much is it going to cost me? What's the rate?
All right, so we've got structure, we've got lender, and then we've got rate. So let's talk about those in order. What's some elements with respect to structure that borrowers should really be thinking about if they want to build a portfolio of property?
Yep. There's a lot, so I'll try and restrict it. But let's say some of the problems that I see, I mean, the majority of my work is really problem solving. People come to me with a problem, how do we solve it? So the structure is part of solving that problem. So some things that I do see, let's say when people do it themselves, they want to invest in a property, I've got some equity, I want to use it. And maybe they've got money sitting in redraw, they've paid down the home, they worked really hard, I'm creating that equity. And they go, I'm going to take that money and I'm going to use that as my deposit and cost for my property. Problem. So the problem with that is, if you're not aware, it's what's called pollution. You're polluting your facility between investment and owner-occupied debt. So when
that's a really critical point, isn't it?
It's
got to keep them separate.
Separate. They've got a clear separation between what's owner-occupied, what's investment, because you want to claim the interest that you pay on that investment facility as a deductible expense come tax time. So without that clear separation, how do you determine what's investment debt as deductible and what's owner-occupied as non-deductible? So that comes up every now and again. Structure.
Well, I was going to say on that point too, is it actually has tax ramifications too. Because if people are mixing investment and personal, and then paying back some of the redraw, you called it pollution. That's muddy waters on top of pollution, isn't it? So it's really critical, and that's what you do by default, is to quarantine the different facilities to make sure that doesn't happen.
Precisely. Yep. So we want to have that clear separation. Structure. You want to get your equity. You want to get that equity out. So again, having that clear separation. Offset accounts. Talk about it a lot. Some banks, you get a single offset account, some you can get multiple offset accounts, which creates additional flexibility with how you manage your money, manage your accounts. Flexibility is important, that you can get equity when needed. If you have to go over 80% LVR, they will allow you to do so. You don't want to be restricted by your lender as to what you do and when and how. You want to maintain that flexibility so that you can build the portfolio to where it needs to be to create that future life.
I always think about you don't want to hit glass ceilings, and by that I mean just because one bank has a certain policy, that your structure hasn't allowed you to get additional borrowings. You don't really want to be able to see that you can borrow more, but sort of keep banging your head on that glass. So that's one of the added benefits of getting structure right at the beginning, isn't it? I always think it's a bit like a game of chess, where you're thinking two or three moves in advance. When it comes to building a portfolio, the same applies, doesn't it? You've got to be not just thinking about this lending right now, but what about the lending I'm going to do later on in the year or next year?
Yep. it's about the end game. What is the end game? Where do I want to be? So from that, we know where you are, we know where you want to be, we know what your equity is, we know what capacity is. So yeah, it's not about how do I get this loan or that loan, it's how do I get from here to there. So the reality is, you have all the banks lined up down a single street, you walk in and out of every door, you will get a different outcome from every single lender, depending on your situation, circumstances, PAYG, self-employed, equity, it all changes. So rather than, I suppose, knocking on every single door, that's where our value is about knowing where you are, where you want to be, and how to get you there with, well, no detours or minimal detours so you can get there quicker.
And it's about knowing, okay, in your circumstances, this is the best option for you versus your friend who you've spoken to at a barbecue that suggested they got a loan with X bank, but their circumstances are totally different. Like you say, they could be on salary and you could be self-employed. So it's really important to understand. And that's something I don't think a lot of people think about when they think about interest rate, is that different scenarios exist for different lenders, and that could undo the benefits of getting the cheaper rate.
Correct. I hear it all the time, say, oh, client, this is the package, this is what we need to do, this is how we're going to do it, this is the cost. And you go and talk to his mates and he comes back and goes, oh, but my friend's getting it for this much or that much. I go, well, that's relative to their situation. What are they doing? What are they trying to do? Are they just getting a standard home, principal and interest, paying it down? Or are they in a similar situation, creating wealth, looking for equity and flexibility? So it's very common, and it's an interesting conversation to try and say, well, yes, rate is important, but what you need to do and your situation, this is how it's going to work.
Simon, do you ever think about it in terms of, it's not about the interest rate you pay right now, it's the amount of interest that you pay over the life of the loan or the life of the portfolio? Because I think that's often forgotten, because if we only really, we talk about each month that the Reserve Bank has an announcement on the first Tuesday of the month to do with the interest rate set, without people understanding all of the things that in terms of structure, it's quite easy for them just to default to rate and how it impacts on them as an owner-occupier. But it's not as easy for people to understand that there are all these ramifications if you are looking to build a portfolio and you get it wrong.
Yeah, well, if you get to a point where the bank says no, well, you're stuck. Doesn't matter what you intend to do. If the bank says no, well, it's no. You can't buy that property. You don't have that in your portfolio. You don't have that working towards your future.
Tell me this, that on that point that you just said, what if someone tries to do it themselves and they go for rate only and the bank knocks them back? It appears on their credit file, right?
It does, yeah. So unfortunately, I have a client who loved frequent flyer points, and he loved it so much he would apply for every single credit card that offered some kind of frequent flyer reward without realising. Now, he hasn't purchased a property previously, so he's gone and done this, and every single time he did that, it hit his credit report. Now, whether that's a credit card or a home loan, every time you apply for credit, it hits your credit report. But unfortunately for him, he'd done it so many times, he can't apply for any more credit for at least the next 6 to 12 months.
Wow.
So if you're going from lender to lender to lender, there will be a point where you've inquired too many times that the answer will just be no.
Well, there's a good point for you there, folks, that if you shop around too much, that will have a negative impact on your credit file. But so we've talked a bit about structure. The next step is obviously to do lender. Why should someone consider using an investment-savvy finance specialist like yourself versus just sort of going to the bank? Because can't they get good opportunity if they've got a good relationship with their bank, for example, that they've been banking with for the last 15 years?
Yeah. Well, my default position on banks is they are a product provider. You go to a bank because you want a product. If you want advice, you come to an advisor. So a banker will do the best they can with the products they have within their institution. So which is limiting, whereas let's say for us, we have 40 lenders, so we've got more product than we know what to do with. So we have just more choice, flexibility to be able to tailor that structure to an individual's needs and not pigeonhole them into, well, I can only put you in one of these 5 options, that one's the best, so there you go. And outside of that, banks do like to cross-securitize. That is a default position that they take. If you don't ask, actually I've even had it in the past where the client specifically said, I do not want these cross-securitized, and I've gone back and I've told them, you need to go back and ask the question, because I know this bank default automatically cross-securitize everything. So they went back and they said, no, you're right. Even though we said don't, they did. They were pretty upset about that.
So that's a really critical point there that Simon's just mentioned, that by default, the banks want to cross-securitize your lending, which as a portfolio builder is not in your best interest. So it's really important that you get someone who is not being paid by the bank specifically for their products, whereas Simon can say, look, here's 3 options that are available to you, but in my opinion, option B is the best because. And it might mean that you're across different lenders rather than getting the best option from one particular bank. So Simon, we talked about structure. We then talked about the differences between lenders. Then we move on to rate. So that's a really good framework for our viewers to think about. But is there ever a time that interest rate becomes more important than those other things?
There is one point. There is a point in the future where rate becomes top of the priority.
Okay.
Once you've gone through the accumulation phase, you've got your home, you've purchased your multiple investment properties, it's no longer about how do I continue to build that portfolio, because now it's just hold and let time take care of the rest. So at that point in time where maybe you've got the home paid down, the property's increasing in value, you've got lower LVR, there's positive income coming through from those properties, well then if you can go back to the bank, and that's when you start focusing on rate. Just as a rough guide, it wouldn't be uncommon for our clients to have at least $1.5 million of debt at some point. So if at that point in time, if you can reduce your rate by, even by 0.3 over that $1.5 million, that's a $4,500 savings a year. On $2 million, it's about $6,000. So once you've gone through the process of building that portfolio, it's sitting there, it's in the bank, it's no longer about how do I continue to borrow money to create wealth, it's about how do I maintain the wealth I have.
Well, that's a really good distinguishing. So through the accumulation phase, structure, lender, rate, but as soon as you move into the maintenance phase, it's all about debt retirement. So through that debt retirement, it just makes sense that you focus your attention on rate. So I think that's some really good points, because the top of this video we talked about is interest rate, the most important thing when it comes to lending. And if you're a property investor who's interested in building a portfolio of properties, I think the message is very clear from Simon, who's doing this all day, every day. It's not the most important thing. It's important to get your structure right first, then your lender, and then your rate. So I've been chatting with Simon Gillespie, who's a senior finance advisor, investment savvy mortgage specialist who knows how to put structures in place for investors every day. So if you've got a portfolio yourself, or you're interested in creating a portfolio for yourself, and you want to make sure that your lending structure is ideal and optimum, why don't you go to our website, empowerwealth.com.au, leave your details, we'll put you in touch with Simon or one of our team so that we can actually assess whether your structure is something that will make sure that you build a portfolio going forward and will serve you well as you get to that maintenance phase. So Simon, thanks for your advice. I think some really good tips there, and hopefully we'll get you on again soon.
Thank you.